Hi, folks. Welcome to the Weekend Investing Stock Market Weekly Review. We've ended the month of July. After four positive months, July has been negative, and the tariff issues continue to roil the markets. And also, there is some sort of a consolidation phase that we are hitting in the markets. From the research desk, we had these fantastic stories to share with you. Please go through them on the Weekend Investing app and or in the newsletter that comes to you every day. Some of them may give you some new insights into the markets. Disclaimer as always, please read it fully, understand it, and only then go forward in this video. Do subscribe to the channel if you haven't so far. And let's get into some charts. So Nifty down 1% this week on the day of the announcement of the 25% tariff. The market did spring back up, but on the next day it did come to terms with the reality and came off. Um, it is still being seen as a negotiation tactic by the US government to bring tariffs somewhat lower from where they've announced. But I think more than the impact of this tariff, India is running its own, sort of issues in terms of growth and in terms of not having any big triggers going forward from here. And foreigners, of course, have been continuously selling into the Indian market. So this last 5 weeks of downward selling move is continuing. Normally, you would find that market would become oversold within 5 or 6 weeks of continuous down moves. But these moves have been small. There has not been any big gashes like these moves have had in the past. So perhaps we will find some support at 24,400, which has been the recent support. Or if we have to go down, then there are several gaps in the chart that are waiting. S&P 500 also moved down, a big bearish engulfing candle there. Employment data has been revised for the last 2 months, and in the current month also the numbers are not so attractive. So it has suddenly caused a major shift in the outlook for US interest rates. Probability for a September Fed hike, which was nearly zero till a couple of days back, has suddenly shot up to 80%. So there is likelihood that interest rates will get cut not once but even perhaps even twice in the remaining part of the calendar year, and that may be good for emerging markets. Falling interest rates in the US usually results in flows from US markets to other markets, and those flows can help India. Gold picked up that cue yesterday and was up about 2% within the same day, up 1.68% this week. We have closed at nearly 10,000 per gram, which is near the all-time highs also. So gold is looking good. If interest rate cut cycle has started, gold will not stop here. It will probably go up. Dollar index, you can see, which was nearly at 97 a couple of weeks back, had shot up to near 100 this week, but then collapsed back on this news of the employment numbers and potential interest rate cut cycle. Interest rate cutting means that money does not move into the dollar but out of the dollar, and that reduces the dollar index going forward. Nifty down 1.09% this week, 1.4% on Nifty Next 50 and Nifty 500, 2% on mid cap, and 2.9% on small caps. If we see 1 year now, we are down very similar to what happened this week, 1.7 to 2.8, 1.7 on Nifty, 2.8 on mid caps, 3.5 on 500, 5.4 on small caps, and Nifty Next 50, which is a large cap, which should have been somewhere here, is down 10.9%. So Nifty Next 50 has really been thrashed very badly. But if we see 5 year returns, you are seeing that all of them are looking very, very pretty. So long term returns are still much higher than the even longer term average. So 5 year returns are much higher than, let's say, 10 year, 15 year averages, and those will look towards going to the mean. So 31% CAGR for 5 years is a phenomenal figure for small caps. Even 3 years is very good at 23.58. So Nifty in 3 years has done its long term average at 12.3%. So some of these probably have more, perhaps, room to consolidate and move towards their longer term averages. In the sectoral overview this week, Real estate got a thrashing, 5.7% down. Defense 4.8% down. Uh, Metals 3.4%. PSU banks 3.3%. Capital markets 3.3%. These have been the uh, sectors that have really done well in the last few years, and that is where most of the beating is coming. FMCG stood tall this week at 3%, buoyed by Hindustan Lever results, which is showing that there is some volume growth or rural growth that is coming back. The rest everything was negative this week, more or less. IT stocks also weak at 2.7% over the last 1 year now. IT stocks are down nearly 15%. Energy is also down 22. Public sector enterprise, oil and gas, real estate, last 1 year has really roiled some of these sectors. Financial services has done well in the last 1 year. Banks have done all right, 7 8%, and capital markets have done phenomenally well in the last 1 year at 43%. So if we see the sectoral momentum across different periods, you find that financial services, MNC, banks, Indian consumption, these are the top three or four sectors in the market. Capital market has lost it in the recent times. Defense also lost it big. Real estate, IT, PSE, these have been consistently in the downward part of the table. And FMCG, you can see here, is coming up very rapidly, along with, you can say, energy stocks that have done well this last 1 week. Weekly advanced decline statistics, nothing to add here on the chart. Everything is down 80 to 85% in terms of the declines in every sector, in every segment, versus the advances only at 17, 15 to 18%. So a comprehensive down week in terms of the breadth of the market. Again, you can see stocks, percentage of stocks outperforming benchmarks, 24 to 34% only. So significant part of the benchmarks are being ruled by stocks that are uh, underperforming the benchmark. Only very few stocks, a quarter of the stocks are outperforming the benchmarks. In the market cap segment wise, drop from 52-week highs, then the picture has not changed much. There is considerable pain in the market. If you just see this 10 to 40% block, you can find that for most segments, this comprises of more than 50%, and and in some places even 75% of the stocks uh, of that segment. So you can easily say that 50 to 70% of the market is down about on average 20% or more, uh, and that is a significant pain in the market. Only 32% of Nifty 50 stocks are are less than 10%. Only 16% of Nifty Next 50 are less than 10%. 18% of mid caps, 14%. So the numbers of stocks which are near their highs or within 10% of their 52-week highs is quite low actually, and this number has increased over the last few weeks. The 40 to 50% bracket, where small caps have seen 14.8% stocks which are more than 40% down from their 52-week highs. So is the trend improving or declining? When we look at it from the 200 DMA perspective, that trend is going down. So you can see here the 200 DMA, 45% of stocks of CNX 500 are below the 200 DMA, which is a substantial number. It had reached to about 62%. It has now dropped to 45%. If we see the 50 DMA also, which had reached about 80% in May, is also now down to 55 right now. So reasonably poor breadth in terms of the 250 DMA. Percentage of stocks above the 200 DMA in various sectors. So metals, financial services, private banks, and commodities are above 60%, which by itself is also not too much. It is just more than half. And then there are sectors like IT, energy, real estate, autos, where it is 20 to 40% only. So significant number of stocks are below the 200 DMA. So market is not in any good shape. Whatever the indices may tell us, the internals of the markets remain quite poor. FIIs continue to sell, so they have sold on all 5 days of this week, and big numbers from 6,000 crores to lowest of 850 crores. And DIIs have bought on all 5 days. Again, good numbers, 6,000 crores highest and 1,800 crores at the lowest. So that trend continues uh, to be the same. 51,000 crores is what FIIs have sold now in the last 1 month cumulatively, and 64,000 crores is what DIIs have bought in the last 1 month cumulatively. So the institutional flow is very well mirrored and matched, but the sentiment is driven by FII flows somehow, and that has been down. So FIIs continue to reduce India exposure, and till that time that we find at least the selling may stop from FIIs, I doubt if we'll have a strong upside anytime soon. So, with that note, I come to the end of the weekly review. Please let us know how you like this content. And if you would like any more data to be added to this, do suggest and give us feedback. Thank you so much. I'll see you in the next one. Bye.